no matter how much human technology improves, we've had trouble making more than 2% more gold per year, right? And that's kind of the upper limit. We don't really know how to make more gold quickly. And so that's why it's kind of stood the test of time compared to virtually every other commodity in terms of being good long-term savings. The whole purpose of money compared to an investment or something like that is that you want it to be liquid, safe, fungible. So if I buy a house or a specific company as an investment, that is something that is risky and that is something that is non-liquid and fungible. Like it's a specific thing. It's hard, it's a hassle for me to transfer it to someone else. That's kind of either a long-term bet or long-term savings or a specific plan to grow my investment with risk of loss. Whereas with money, it's kind of the opposite. I want like a low risk battery of storing income now so that I can expend it in the future or share it or give it away or whatever I want to do. And so it's got to be liquid. It's got to be something that I can just easily transfer to someone. It's got to be something that is easily divisible, fungible, so that all the units are either identical or nearly identical. And it's got to be something that holds its value that I want to hold it longer term. And then I want to add other things like you want it to be verifiable, you want it to be portable, and there's multiple ways to break that down. You can kind of look at different monies and like VJ did, for example, you can score them on the different aspects, right? So for example, gold holds its value pretty well long term, right? Because gold's got a very, very low inflation rate, meaning the amount of gold that exists above ground grows at a very, very slow rate historically. And there's a good reason for that. And so gold ends up being a very good store of value, but it has shortcomings in terms of portability, divisibility, verifying that what you actually own is gold, like the ease of being able to do that. Whereas when you look at something like the dollar, they've made advances for how easily you can send it around, right? Because it's, you can have digital representations of it. And you can, it's very easy to move around. But of course, the downside is that, there's no constraint on how much they can print other than kind of self-imposed restraint that is kind of meant to keep guardrails on the system and stop it from hyperinflating. So there's kind of guardrails on it, but they're self-imposed. And so over time, in practical terms, the rate of new dollar creation is much faster than the rate of new gold creation, right? So when you compare those, you think, okay, those are interesting. We obviously have to pay them for tax purposes. We have to have some working capital to use them. They're liquid. The government specifically does their best to try to control the volatility at the exchange of devaluation, but they try to control the volatility of it. And so there's advantages, but they're not a great long-term place to store capital. And one way to think about fiat currencies is they try to optimize for low volatility, but then the sacrifice they make is devaluation, right? So they kind of have this manual adjustment mechanism where if you get deflation, they want to print a lot more. If they start getting inflation, they try their best to throttle that back. And they've had mixed success with that. But basically, you never really have a case where developed market currency is like, 50% less useful the next year, right? Whereas that can happen with Bitcoin, even more so. Now, in extreme historical events, even those fiat currencies, they break down. So they go decades and decades and decades without having a major volatility event. And then you get like a 1933 event where it's just, it's practically cut in half. Or you have like emerging markets go through this far more often. The Egyptian pound had a month where it was just cut in half about 5 years ago. And so that kind of thing is common throughout the world, unfortunately. But in developed markets from year to year, the volatility is low. And that combined with the fact that it's recognized as legal tender makes it a useful form of kind of like near-term money that you can save it. It's going to be worth roughly the same in 6 weeks, and you kind of go about your day. If you're living in a country and you're making $400 a month, and your expenses are $400 a month, you can't like risk holding a lot of your assets or whatever assets you might have in something that can go up 50% or go down 50% during that time. You pretty much have to have a stable amount because you have no margin for error. Whereas, of course, if you have a large pool of capital, you have a better ability to withstand volatility. So it's kind of a privilege to be able to accept volatility for harder, better money in the long term. Currency is generally very low volatility over, say, a 2-month period, except for extreme events. Then you have gold that's more volatile than that. And then Bitcoin's obviously far more volatile than that. And that's actually one of the downsides longer term, is that there's then an inverse correlation between volatility and their ability to hold value long term. And so the cost of that volatility management is ongoing devaluation. Yeah, I think during monetary transitions, that becomes very common to use multiple types of money.
Yep.
Like you were saying in Venezuela, for example, there's like 5 common types of money, and that's because they're going through a very difficult time. It's kind of like the more stability there is, the less need there is for multiple types of money. And when you have all these imperfections with different types of money, or at least imperfections as part of their journey. So for example, Bitcoin's imperfection, we can call it, is the volatility. But you're early on and that volatility is inevitable, right? So whatever the type of money might be, there's going to be like a downside to it. And so they kind of use that for the things that it solves and use another type of money for the things that solves. And so when we go back to what we can do with our assets, right? So if we have a surplus of what we generate versus what we do, we can either, one, we can just consume it. We can just use it up in various ways, discretionary. 2, we can save it. And the whole point of savings is something that you expect to not be super volatile, but that of course is different time frames. So you might want to save for something 6 months from now, and you need to have pretty low volatility for that. If you're saving up for a down payment on a house, for example, compared to something, if you're saving multi-year, you're willing to accept more volatility, but you still want it to be pretty much a sure thing. You want it to not lose value significantly over the longer term. Gold has like an inherent kind of a difficulty adjustment built in. So as time progressed, we got a lot of easy gold deposits, and as our technology improved, we could access harder gold deposits, but it's increasingly hard to get that gold. And so actually, almost no matter how much human technology improves, we've had trouble making more than 2% more gold per year, right? And that's kind of the upper limit, except for very brief moments where we find a new continent or some sort of massive step change. Other than rare moments like that, we don't really know how to make more gold quickly. And so that's why it's kind of stood the test of time compared to virtually every other commodity in terms of being good long-term savings. But because the downside is portability and auditability, it eventually got very centralized. So it would get collected in banks and claims would be made on the gold. And then it got increasingly collected into central banks, where not even banks held the gold anymore. And so you had a complete detachment from what people used as medium of exchange, partially for convenience and partially due to legal decree. Governments had an interest in kind of collecting the gold, while people, would be expected to use the papers. And then but the risk there is that you can just, with a stroke of a pen on midnight one day, just sever the connection between those papers and the gold. And that's what happened in countries around the world multiple times until it happened permanently in 1971. And so we've been in this era of fiat currency where it's almost like an artificial commodity. So for example, the rate of, the stock to flow ratio, so how much money exists versus how much is created in a year, is higher than most commodities. So that's important as a money.